Not that long ago, the whole idea of investing absolutely terrified me. I'd managed to save up a little bit of money, but I was totally, completely paralyzed. Paralyzed by the fear of losing it all, confused about where to even start, and just this nagging feeling that I needed a finance degree or thousands of dollars just to have a shot. And I bet that's a feeling a lot of you have right now, that mix of ambition and anxiety. You see the headlines, you hear the success stories, but taking that first step feels like jumping off a cliff in the dark. But then I found a dead simple strategy, one that didn't just quiet those fears, but also turned a tiny initial investment into my first $1,000 in profit. And in this video, I'm not just going to tell you about it. I'm going to show you the exact step-by-step method I used so you can do it too, even if you feel like you're starting from absolute zero. So, before we get to the how, we have to talk about the why. Why do so many of us just wait? For me, it was a few big fears that all rolled into one giant monster of doing nothing. First, there was the big one, the fear of losing money. We work hard for our cash, right? The thought of putting it into something that can go down is genuinely scary. Unlike a savings account, the stock market zigs and zags, and nobody wants to see their money vanish in a market dip. I was positive I'd be that guy who invests the day before a huge crash. Second, it was just so overwhelmingly complex. It felt like trying to learn a whole new language. What's an ETF? A mutual fund? A bond? What the heck is an expense ratio? The jargon alone was enough to make me close the browser and go watch cat videos. This analysis paralysis is real. You get so busy trying to learn everything that you end up doing nothing. And finally, I just believed I didn't have enough money to start. I thought you needed a big chunk of cash, like 5 or 10 grand, for it to even be worth it. Anything less felt pointless. This is one of the biggest myths in investing, that it's only a game for the rich. But here's the reality check I had to face, and the one you need to hear right now. While you're waiting on the sidelines, stuck in that fear, a powerful force is working against you every single day. That force is inflation. The money just sitting in your bank account is losing its buying power. It's like you're on a treadmill you can't get off of. Just saving your money isn't enough to get ahead. You're actually, slowly, falling behind. The real risk isn't just losing money by investing. It's guaranteeing you lose money by not investing at all. So how did I break through that wall? I stopped trying to be a genius. I gave up on finding the next big thing. Instead, I embraced a strategy so simple and so proven, it almost feels like cheating. I stopped looking for the needle in the haystack, and I just bought the whole haystack. What does that actually mean? It means I stopped trying to pick individual stocks. Forget trying to guess if Tesla will go up or if Apple will go down. Even the pros get that wrong all the time. In fact, studies consistently show that most professional fund managers fail to beat the market average over the long run. So here's the strategy. Invest in a low-cost, broad market index fund ETF. Okay, that sounds like a mouthful, but let's break it down. It's the only piece of jargon you really, truly need to know. An ETF, or exchange-traded fund, is basically a basket of investments you can buy as one single thing, just like a stock. But inside that basket are hundreds, or even thousands, of different stocks. An index fund is a special kind of ETF that doesn't try to pick winners. It just copies a major market index, like the S&P 500. The S&P 500 is simply a list of the 500 largest, most established companies in the US. So, when you buy just one share of an S&P 500 index fund ETF, you instantly become a small owner of 500 of the biggest companies out there: Apple, Microsoft, Amazon, Google, all in one click. If one of those companies has a rough year, it's cushioned by the other 499. That's instant diversification. It's literally the definition of not putting all your eggs in one basket. And this one simple idea crushes all the fears we talked about. Afraid of losing money? Spreading your investment across 500 companies massively reduces your risk compared to picking one or two. Afraid of complexity? You don't have to analyze a single company. You just buy one thing. Afraid you don't have enough money? You can buy into these funds with whatever you've got. Seriously, $50, $100, it doesn't matter. This isn't some weird, obscure strategy. This is the exact approach that legendary investors like Warren Buffett recommend for the average person. You get the growth of the entire market over time with incredibly low fees. All right, Here's the part you've been waiting for. The exact, actionable steps to go from zero to actually invest it.
Before you invest a single dollar, you got to do two things. First, pay off any high-interest debt, like credit cards. The interest you're paying there will almost always wipe out any gains you make from investing. Second, build a small emergency fund. This is about 3 to 6 months of essential living expenses kept in a safe place like a high-yield savings account. This is your safety net. It makes sure you never have to sell your investments in an emergency. Investing is for the long haul. Don't use money you might need next month. This sounds scary, but I promise you, it's no harder than opening a new bank account. You just need to pick a brokerage firm. The big three that are amazing for beginners are Fidelity, Vanguard, and Charles Schwab. They're reputable, easy to use, and offer commission-free trading on stocks and ETFs, which means you don't pay a fee to buy or sell. You can do the whole thing online in about 10 minutes. You'll need your social security number and bank info. While you're opening the account, look for the option to open a Roth IRA. Think of a Roth IRA as a superpowered investment account. Your money grows completely tax-free, and you can pull it all out in retirement, again, completely tax-free. If you're investing for the long term, this is one of the best wealth-building tools you have. Once your account is open, it's time to move some money into it from your bank. You can start with whatever you have, $1,000, $500, even $100. The amount is so much less important than the action of just starting. This is the moment of truth. You're going to log into your shiny new account, find the trade button, and buy one ETF. Here are 3 of the most popular S&P 500 ETFs. They're all nearly identical, so you just need to pick one. All 3 of these do the exact same thing. They track the S&P 500. VOO and IVV have tiny expense ratios, around 0.03%. That means for every $10,000 you have invested, you're only paying about $3 a year in fees. It's practically free. You'll type in the ticker symbol, tell it how much money you want to invest, and hit buy. And that's it. You did it. You're an investor. You are now a part owner in 500 of America's biggest companies. Just let that sink in for a second. Okay, so you bought your first ETF. You're invested. Is that how I made my first $1,000? Not quite. That first purchase was just the start. The real secret, the thing that separates people who just dabble from those who actually build wealth, is what you do next. And what you do next is 2 simple things: automate and wait. Right after I made that first purchase, I set up an automatic investment. Every single month, on the same day, a set amount. I started with just $100, was automatically pulled from my bank account and invested into that same ETF. This is called dollar cost averaging. Some months, you buy when the price is a little high. Other months, you buy when it's on sale. Over time, it all averages out, and it removes the single biggest enemy for any investor: emotion. You stop trying to time the market and just focus on accumulating. And then you wait. You let the 8th wonder of the world do its thing: compound interest. Compounding is just your money making money, and then that money making more money. It's a snowball rolling down a hill. At first, it's small and slow. My first few months, my account barely budged. That first $100 in profit felt like it took forever. But as my balance grew from those consistent investments, the snowball got bigger. The gains started compounding on a bigger and bigger pile of money. That's when I saw the growth really speed up, and before I knew it, I'd crossed that first huge milestone: $1,000 in pure profit. It wasn't some brilliant stock pick. It was the boring, consistent, automated process of buying and holding. Time is the most powerful ingredient in this recipe. Look, the strategy that made me my first $1,000 wasn't a secret tip or some complex algorithm. It was giving up on the idea that I had to be a genius. It was about embracing the simple, proven power of consistency and time. The path is right there for you. Build a solid financial foundation, open a tax-advantaged account like a Roth IRA, buy a simple, low-cost index fund like VOO, and this is the most important part: automate your investing and have the patience to let it work. That first $1,000 isn't just money. It's proof. It's the seed for your entire financial future and all the momentum you need to keep going. You don't need to be afraid. You don't need to be an expert. You just need to start. If this video helped clear things up for you at all, do me a huge favor and hit that like button. And for more simple, No BS guides to building your wealth. Make sure you subscribe. Now I've got a question for you, and I want you to be honest in the comments. What's the single biggest fear that's been holding you back from investing? Drop it below. I'm going to be reading through and responding to as many as I can. Let's tackle these fears together. Thanks for watching, and I'll see you in the next one.